3M is a favorite for dividend investors with its 5.85% dividend yield. It is currently trading at $102.57 a share. What I'm going to be doing today is looking at their most recent earnings, then taking it to my automated stock valuation spreadsheet using discounted free cash flow models, the Ben Graham model, and the comparable company model to see if 3M is a buy or a sell. So if we look at the stock price over the last year, you can see it is down almost 24%. And this stock has been on a bit of a downward, even on the longer periods as well. It was previously trading at $200 back in 2021, down 50% from there. Can it get back to those numbers? That is the question we're going to answer today. So this is the most recent earnings. And actually, if we just take this to Google, it'll give us a quick summary here. Revenue on year over year is down a bit, down 9% to 8.3 billion. Net income down 25% year over year to $1 billion. Diluted earnings per share down. Basically, everything is down. Net cash. The only positive here is net change in cash. That is up. But you can see it beat earnings per share by about 23%. So that is some good news there on the stock. So let's take it to my stock summary sheet. What we'll do is we'll put in the ticker 3M or MMM. If you're interested in this sheet, please check out my Patreon. Links are in the description. But what this will do is we'll load up all the information that we want to see about 3M. So they have a very low PE ratio of about 10.62. The market is around about 25. So it is definitely lower than the market. Earnings per share, $9.65. A beta of 0.95, which means it sort of swings less. Well, it's sort of very in line with the market. One would obviously be in line, so it's slightly less volatile than the market. Dividend 5.81% calculated here. Now this number does change quite dramatically. If we look at this website here, Dividend Max, when is the next time this is paying a dividend? Well, the dividend will be declared on the 11th of August, ex-dividend date 18th. So if you buy your shares before then, you will get paid. If you had 100 shares of 3M, you get $150. Obviously, that is quite a lot of shares, but you can see this is a massive payer, 5.9%. So let's just go back to my sheet here. Dividend, they pay out $3.3 billion. Is it a safe dividend? Well, it is on the higher side, actually, if you see it here. The payout ratio is 60%, and in terms of the free cash flow payout ratio, 81%. So it is a safe dividend, but it is quite high. And you can see here on my automated sheet, around about the 18th of August is the ex-dividend date. Now, let's have a look at the revenue. So we've got 2018 to 2022. Sorry, this will be updated as well. In the trailing 12 months, which is obviously the last 4 quarters, you can see revenue is very, very steady. 33 billion to 33.4. So that is pretty much flat, but slowly increasing. We had some big years in 2020 and 21. Next, we want to see net income. Once again, a similar story, pretty flat again. It really needs to see how these next few quarters go, because in 2022 it was up about $500 million. So really it is flat, but slowly increasing. Shares outstanding, what are they doing with their shares? They're buying back shares. They're rewarding shareholders. If the revenue's not growing, the net income, they are buying back their shares. Now, if we just look at the share price, really it is when the stock price was going up, they want to buy in the shares, because obviously what this means is if there's 10 shares in the market, you own 1 share, then you own 10% of the profits of the company. But if they buy back 5 shares, your piece of the pie goes up to 20%. So if they continue to buy back shares when it's currently at $102 a share, that is good, because obviously the stock was previously $200. So they do think it is undervalued. Free cash flow. What can they do with free cash flow? Well, this is cash from operating activities minus capital expenditures used to upgrade the company, buy physical assets, plants, property, equipment, but also it can allocate dividends, pay down debt, and growth opportunities. And their free cash flow, similar story with all these, pretty flat. Had some highs of about 6.6, some lows of 3.8, but it is on the upswing, which is what we want to see. So let's have a look at the trailing 12 months discounted free cash flow, because we have got these most recent numbers and we can see that the stock is a buy. Discounted free cash flow model says that it is a $204 stock. Let's have a quick look at these numbers and see if we see anything. Obviously, revenue is pretty flat. That is what we are expecting. If we just have a look at those net income margins, once again, similar amount, about 16%, and the net income, the free cash flow rate is about that as well. So I think these are pretty fair numbers, and it does spit out at $204 a share. Now let's have a look at the Ben Graham model. Well, what is this? This is The formula for valuation growth stocks created by Ben Graham. And let me just scroll up so you can see that. Yes, the final adjusted Ben Graham formula. What this does is it looks at the growth of the company over the next 7 to 10 years, earnings per share, P of a non-growth company. These are the revised numbers, 7 and 1, 4.4 for the average, and then Y is the current AAA bond yield, which we can see here is about 4.67. If we look at the bond yield, it's been all over the place, but we have had a bit of a jump since the pandemic. If I can even say that on this platform, I don't even know. So let's have a look at what the growth rate is of this company. I'm going to imagine pretty low. And yes, analysts are expecting over the next 5 years around about 1.64%. So let's put that in the calculation. I don't think the Ben Graham formula says this is buy. Yes, it puts it at about an $80 stock. So not a buy, and the Graham price is sort of a buy and hold. If it ever drops this level, it's a no-brainer. So if we were to say the company was at about 5%, that would be a fairly valued. If the company could grow 10%, that would be quite the thing. But yes, currently it is about 1%. Now let's just have a look actually at what the previous 5 years of the company was. Obviously the companies do grow slower, but you can see it's about 0.5%. So neither the Ben Graham model does not particularly care for this stock, but we do have a few other things. The last one I want to look at is the comparable company analysis. So what this is it uses metrics to evaluate similar companies of similar size. Enterprise value is market cap plus debt, and we want to look at the revenue, the EBITDA, which is earnings before interest, taxes, depreciation, and amortization, the net income, and then the metrics that we're interested in are EV to revenue, EV to EBITDA, and PE. So 2 of the companies that I want to see here. And also, sorry, I didn't say this in the last video. It's been a while since I've done one of these, so I've been a bit all over the place. We want to see that the lower number is better. Lower EV signals that the company is undervalued, and same for E to EBITDA. So all of these you want lower. So let's put in 2 of the company's sort of comparables. One is General Electric, and then the next is HON, ticker HON, which is Honeywell International. So if we look at these, the equity value of 3M is a lot smaller than these two. Now this stock was at 200, was twice the size not too long ago. But if we want to see, if we look at EV to revenue, you can see it is in the middle towards, actually it's between these two, but on the lower side, so that is good. EV to EBITDA, once again, it is lower. And PE ratio, the PE ratio isn't going to work here because of the implied stock price here because of Honeywell being not profitable. But the fact that is a 10 PE ratio, obviously the calculations don't work, but this is undervalued in terms of PE. Now, if we look at EV to revenue and EV to EBITDA, based on these multiples, it is undervalued. It's probably valued at about, if we take an average of these, well, 160, 114, and whatever this is. So really $150 stock based on the comparable company model if you're comparing it to General Electric and Honeywell. So it does look like it's a buy. The stock has been pretty flat and been decreasing, but in terms of financials, it is a solid company, and you get that sweet 5.85% dividend. Right, guys, thanks for watching. Please give a like on the video if you enjoy it, subscribe if you're not already, and I'll catch you guys next time.